Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, January 29, 2025. Hope everyone's out there having a fantastical day in the interwebs. It's a pretty nice day here in Colorado. Got to go out and do some shopping and stuff like that. So got back early, so I got to do my recording on time, which is always good. So also, it's my oldest birthday. Happy birthday, Ryan. He is a young 35 years old. So anyways, all right. Well, markets are holding steady as investors await major tech earnings and the Fed's decision with expectations that rates will stay put. They did. Meanwhile, UK businesses are struggling under tax and wage hikes, while Australia is making remarkable progress in taming inflation. In the US, Trump has ordered federal employees back to the office or out the door, sparking legal challenges. And on Wall Street, big banks are boosting bonuses for top execs, leaving junior staff disgruntled. Before we break it all down, I need some help from you. If you could give me some thumbs up, like, a share, subscribe, a follow, and press that notification bell. All righty. Well, let's hop into the markets. Dow Jones was down 0.31%, 137 points, closed at 44,713. S&P 500 down 0.47%, 28 points, closed at 60,39. NASDAQ down 0.51%, 101 points, closed at 19,632. The VIX was up 1.28% today. It's at 1662. Canada up 0.21. Brazil down 0.47, and Mexico up 0.03. In Europe, Germany was up 0.9, the UK up 0.28, France down 0.32, the Netherlands up 0.73, Spain up 1.09%, Italy up 0.62, Switzerland up 0.6, and Portugal up also 0.62. Let's see here. Russian exchange is green today. MOEX up 0.49, RTSI up 0.44. And the overnights, the Nikkei in Japan was up 1.02%, Australia up 0.57, New Zealand up 1.09%, and the Chinese markets have not been open at all today. So we'll skip those. All right. Pretty cool. All righty. Well, let's hop into our market recap for today. S&P 500 falls as Fed voices inflation worries. Big tech earnings are next. All right. The S&P 500 retreated on Wednesday after the Federal Reserve reiterated that inflation remains somewhat elevated, removing previous language suggesting progress towards its 2% target. As expected, the FOMC left interest rates unchanged, but the shift in tone signaled fewer rate cuts than previously anticipated this year. I mean, I think they were talking originally like 3 or 4, and now they're down to like maybe 1. Where was I? The decision follows President Donald Trump's push for immediate rate cuts in his address to the World Economic Forum in Davos earlier this month. The Fed's decision to pause its rate cutting cycle reflects concerns that inflation remains stubbornly high. Well, they shouldn't have been lowering rates in the first place, in my opinion. But hey, what do I know? I think it was purely just to appease the previous administration and hope in the hopes that he would earn re-election, which didn't happen. Alrighty, where were we? The removal of its reference to progress towards lower inflation could indicate a more cautious approach. The shift in sentiment led traders to scale back expectations for interest rate cuts in 2025. Additionally, Trump's tariff proposals and other protectionist policies could add inflationary pressures, further complicating the Fed's decision-making process. Major tech companies have driven recent stock market gains. Microsoft, Meta, Tesla, and Apple are set to report quarterly earnings this week. AI development remains a central focus for investors, especially following Monday's sell-off triggered by concerns over Chinese AI startup DeepSeek. Sentiment on chip stocks improved as Dutch chipmaker ASML posted strong earnings, indicating continued demand for AI-related infrastructure. Some corporate standouts, T-Mobile soared 7%, forecasting higher than expected subscriber growth thanks to holiday promotions and strong demand for its 5G plans. Well, they advertise like crazy. I see them all the time when I'm watching sports. Starbucks jumped 7% also after posting better than expected sales, suggesting its turnaround strategy is gaining traction. Trump Media and Technology Group climbed 6% after announcing plans to expand it into financial services with a new fintech brand called Truth.fi. And finishing up here, the Fed's hawkish tone dampened hopes for immediate rate cuts, while big tech earnings and AI innovation remain key drivers of market sentiment. Investors will closely watch Apple's report on Thursday to gauge the health of consumer demand and tech spending. Yeah, again, I don't know why everyone's in this, frenzy to lower rates. I mean, keeping rates at zero has created a ton of problems since 2009. And, and then when you increase the money supply on top of it, it just, compounds the issue with inflation. So, I mean, it's kind of like saying, someone's like, they want to run a marathon, but they've never run it all. And, they're just like, they put on their shoes and just, I'm going to go out and run, what is it, 23, 28 miles, whatever it is, or 26 miles. And you'd be dead within, the first quarter of it. So you just can't just jump into something like that. And I know everyone, it's nice to have lower rates on your loans and things like that. But at the detriment of this economy, it just, it has short-term benefits to the people who get the money first and, can take advantage of the lower rates. But in the end, all it does is create more inflation in the economy. All right. Next up, let's see here. This is from Zero Hedge, 2 charts that should worry the Fed and Trump. Let's see what they had to talk about. Consumer spending and labor market signals raise concerns for the Fed. Consumer spending, which accounts for over 2/3 of the U.S. economic activity, is heavily influenced by income security and job confidence. Recent data suggests that consumer confidence and income stability is plummeting, signaling potential economic trouble ahead. A University of Michigan survey on real household income expectations has fallen to its lowest level on record. Historically, there is a strong correlation between consumer confidence, the unemployment rate, and economic activity. When job security and wages keep pace with inflation, people are more willing to spend. However, if layoffs rise or wages stagnate, consumers will pull back on spending and increase savings, which could slow economic growth. And I think this is the chart right here. So if you click on the third hyperlink in the show notes, you can. This first chart shows where this is right here. Where were we? Economic growth. Despite headline labor market data appearing stable, underlying indicators suggest a weakening job market. Continuing jobless claims are at their highest level in over 3 years, and the JOLTS hires rate has dropped to a 10-year low, while layoffs remain low. Businesses have slowed hiring significantly. Additionally, employment expectations are declining, which has historically preceded a rise in unemployment rates. If this trend continues, consumer spending could weaken, which may force the Federal Reserve to rethink its economic outlook and rate policies. The Fed must monitor these warning signs closely. All right. So that's not good. All righty. So next up, also from Zero Hedge, watch live Fed Chair Powell's first Trump 2.0 press conference. Go through some of their observations here. Following the least anticipated Fed meeting in recent history, the central bank held interest rates steady, with Fed Chair Jerome Powell maintaining a cautious stance on inflation. The statement was perceived as somewhat hawkish, removing prior references to inflation making progress toward the 2% goal. Yeah, it hasn't been doing that in a while, which surprised the markets. Well, anyone paying attention to inflation would have known this. Bond markets reacted by scaling back expectations for rate cuts, with March pricing dropping to 5 basis points, and June no longer fully pricing in a cut at all. July is now the market's new target for the first rate reduction. Powell's comments signaled that the Fed will remain patient despite recent soft inflation data. The press conference was expected to create more volatility than the modestly hawkish statement, with markets focusing on Powell's potential reaction to Trump's pressure for lower interest rates, inflation risks from tariffs, and AI-driven market instability. DeepSeek. If I could pause here, I do find it funny that they were more willing to cave to the previous administration that on lowering rates in the first place over the last year. But Trump's back. I mean, again, I would, if I was in Powell's shoes, I wouldn't lower rates anymore either. But I find it interesting that they were willing to bend to the left. I mean, maybe Biden's administration had naked pictures of Powell, with a little kid or something. I don't know. All right, jumping back in, market scenarios post Powell. Best case, 55%. Powell maintains that monetary policy remains restrictive, with expectations of 2 cuts in 2025. He acknowledges recent inflation progress, but remains cautious. Let's see. Hawkish 20%. Powell warns of reaccelerating economic data and persistent inflation risks, delaying rate cuts further. And a dovish tone 25%. Powell focuses on weak labor market indicators, slowing housing inflation, and quantitative tightening discussions, hinting at a potential softer stance. With Trump advocating for lower rates and tariff concerns lingering, Powell's challenge remains controlling long-term yields while maintaining credibility in an increasingly politically charged economic landscape. We're in for a hell of a ride, folks. All right. Last, just an article from the Mises Institute titled Tariffs Will Not Make America Great Again, written by Connor O'Keefe over there at the Mises Institute. So let's see what he had to say. All right. Following Colombia's refusal to accept deported migrants, or illegals, as I like to call them, President Trump swiftly imposed a 25% emergency tariff on Colombian imports, only to roll it back once Colombia relented. However, Trump is now reportedly considering a similar 25% tariffs on imports from Canada and Mexico, signaling a broader trade war strategy. Trump's pro-tariff stance aligns with his campaign promises to protect American workers and businesses, but critiques argue that tariffs are a double-edged sword that could raise prices and hurt consumers. Yes, that is true. While protectionism is often framed as defense against outsourcing or multinational exploitation, economic theory suggests that tariffs reduce supply, raise costs, and ultimately hurt American workers by making raw materials like steel, oil, and lumber more expensive. Well, maybe get those supplies from America, and you don't have those problems. Historically, tariffs have led to higher prices and economic inefficiencies, disproportionately affecting small businesses and middle-class consumers. Supporters claim that tariffs generate government revenue. Well, they're just going to waste it and reduce reliance on foreign economies, particularly in times of geopolitical tensions. However, skeptics warn that retaliatory tariffs from other nations could undermine U.S. exports, making American goods less competitive. Additionally, some argue that Trump's tariff push isn't about long-term trade policy, but rather a bargaining tool to pressure foreign governments into policy concessions. However, history suggests that tariffs often escalate trade conflicts rather than resolve them. The Civil War be a perfect one. That was, in my opinion, the main reason of the split between the South and the North was the doubling of the tariff in 1859, 1860. Because that's really what pissed off the South. The real economic solution, critics argue, lies in reducing federal bureaucracy, deregulating industry, and ending Washington's global interventionism, not increasing taxes on American consumers through higher import duties. Yeah, I can agree with that. So, granted, we're taxed to death. So, until the federal government downsizes to a tenth of its current size, I just don't see us really making any progress. Yeah, you can have tariffs, and I know they're throwing rumors out there about getting rid of the income tax and things like that, which my wife and I have donated about $1 million in the last 20 years to the federal government, so we would have no problem keep holding on to that money. But anyways. All right. Well, that's everything that I have to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to call. All right. Well, hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.